All right, welcome back. You've made it to the final video this week. I know we've covered a lot of ground so far, and we're almost in the home stretch. We got a little bit more to go. Now, in this video, we're going to talk more about the economy. The government plays a really big role, has a huge impact on the economy. Our national spending is to the tune of trillions of dollars every single year. Policymakers are very involved in the economy, really trying to influence the economic growth and all kinds of decisions that really have an impact on how Americans perceive the economy, how good the economy is, how good their jobs are, how much money they're bringing home. So that's really what we're going to be talking about in this video, is about how the government spends money and also how the government taxes. So these are the kind of concepts that I want you to be aware of. Understanding these two different approaches of laissez-faire economics and Keynesian economics. We'll get into that in just a second. You're going to understand three different types of taxing. We've got progressive, regressive, and flat taxes. And then finally, I want you to understand the difference between the deficit and the debt. We're going to go under each one of these in detail, kind of understanding each one of these terms. So here you see two very influential economists that were active during the 1900s. On the left, you've got Friedrich Hayek, and on the right, you've got John Keynes. Now, Friedrich Hayek represents the Austrian School of Economics. These are going to be economists who are very much in favor of having a free market, laissez-faire system, getting the government out of the way, getting the government out of regulating the economy. On the other hand, you've got John Keynes, who went on to establish Keynesian economics. They're going to take the opposite approach. Keynesians are going to be very involved in the economy, in trying to spur people to spend more in different times and to use monetary policy to slow down the economy in other times. They're going to be taking a much more active role in managing the economy. So let's first start off by understanding this term of laissez-faire economics. Now, in French, the term laissez-faire literally means let it be. And that's exactly what the approach would be from government. Let it be. Get out of the way. Don't interfere in the economy. So under laissez-faire, there would be no kind of intervention from the government, no subsidies for businesses, no bailouts for failing corporations. You're allowing the market to self-correct and self-regulate. This can really be kind of demonstrated by an article that was written back in 1958 called I, Pencil by Leonard Read. The whole story is about this concept of how there's nobody in the world who really knows how to make a pencil. There's all kinds of different inputs that go into it, everything from the wood to the lead to the paint to the metal, that's on the eraser tip to the rubber. And there are literally thousands of people who are involved in sourcing and manufacturing all of that stuff and bringing it all together to make a pencil. And so the idea in that article is that if the government gets involved in regulating one part of the economy, a lot of times it could have spillover effects and make situations potentially worse in other areas. If you ever get a chance to read it, I really recommend it. It's a very interesting read. It's this idea of the government not interfering, the government getting out of the way, understanding that the economy is going to be more efficient and lead to probably lower prices for everybody if that happens. Now, the Austrian school that we talked about just a moment ago, including Friedrich Hayek, they talked about this idea that there's a cycle in businesses. You've got some times where the economy is doing really well and it's growing and companies are making a lot of profit. And then you have other times when the economy contracts. We call those times recessions. And it's where the economy is essentially shrinking. And the Austrians, they said that's a normal part of the economy. We should allow that to happen. When there's a recession, you kind of get rid of some of the businesses who maybe aren't doing so well. And that's actually a good thing overall. Now, in come the Keynesians. So under Keynesian economics, they take sort of an opposite approach. Now, Keynesians really wanted to understand, is there a way that we can make recessions less harmful? Is there a way that maybe we can, when things get bad, is there a way that we can maybe stimulate the economy so that the economy gets good again? And so under Keynesianism, what they want to do is take a more active role in terms of regulating the economy. So they're going to do things like encouraging borrowing, encouraging people to take out debt when the economy is bad, hoping that that will spur more investment, more spending, and get the economy going again. During times when things are a little bit too hot in the economy, they might raise interest rates really high to sort of slow down the rate of borrowing and so forth. So long story short, Keynesians are very in favor of greater economic involvement in the economy. We saw a lot of this type of approach during the COVID pandemic, especially during the period of time where there were lockdowns. You see that image on the right there, which is actually what those stimulus checks looked like, where you had the government essentially sending checks to people, hoping that they would use that money to help stimulate the economy during that time. So we've got these two separate approaches, okay, the laissez-faire and Keynesianism. We could spend a lot of time going into that. I'd actually love to, but given our constraints in terms of time, we're just going to leave it there for the moment. Now, we're going to talk about taxation too, okay? So the government, to fund itself, raises taxes. I want you to understand these three different types of taxes. And we're going to start with the idea of progressive taxes. Now, the idea of progressive taxes is that as somebody's income increases, their effective tax rate is also going to go up. What this means in practice is that low income earners, they're going to pay a lot less in taxes, at least in terms of a percentage of their take-home pay, than somebody who makes a lot of money. So this is the way that the federal income tax is structured. So there's actually about 57% of Americans that really don't pay any federal income tax at all. And the higher you go up, the higher you make in terms of your pay, the more money you're going to spend. So somebody could spend, or if they bring home a lot of money, they could be paying up to 37% of their salary going directly to the government in the form of taxes. So of the top 5% of income earners in the United States, they pay about 60% of all income tax. So it's this idea that if you're low income American, you probably won't be paying as much. If you're a very higher income American, you're going to be spending a lot more in taxes. We call that a progressive tax system, and our federal income tax is one example. That's going to get us on to the flip side of that, which is regressive taxes. Now, a regressive tax, in a sense, is going to hurt low-income people worse. And the example that I'll give of this is like gas taxes here in California. So it doesn't matter if you're rich or poor or middle class. If you go to the gas pump, you're paying a flat tax on that. You're paying the same amount of taxes per gallon as anybody else. And, that's going to hurt low-income people the most because you got to drive to get to work. You're going to pay for your gas. The person rolling up in a really expensive car and making a ton of money, they're going to pay the same amount. It's not going to hurt them as much as it's going to hurt somebody who's lower income. So that regressive tax is typically a tax that's going to apply to everybody, and lower income people end up paying a greater percentage of their salary. We can also look at things like, taxes on tobacco or alcohol as being another example of this. Now, finally, we're going to look at flat taxes. We looked at progressive, we looked at regressive. There are some states that when they have their income tax, everybody is paying the exact same percentage. So Colorado is a great example of this. If you live in Colorado, it doesn't matter how much money you make, you're going to be spending about 4.6% of your income towards the state income tax. You could be making millions of dollars a year and you're going to be paying that 4.6, or you could be low income, you're paying 4.6. Essentially, everybody is paying the same rate. That's what we're going to call a flat tax. Okay, so just know the difference between those three. Progressive, regressive, flat. How are they different from each other? Now, finally, okay, so we've talked about this idea of the government taxing. The government also spends. They're spending that money, right? So the government's going to collect taxes and they're going to spend that money on social programs, military defense, and so forth. But unfortunately, the government often spends a lot more money than it takes in. And so if the government is going to spend more than it takes in, then it's running a deficit and it's going to build up the debt. So the next two terms that I want you to be aware of are deficit and debt. Let's start with deficit first. And we can use the example of somebody who's just like running up the credit card. Okay. If you, let's say you take in a certain amount of money every month and then you go and spend a lot more than that, you've got a deficit on your hand. Whatever that difference is between what you earned and what you're spending, that's your deficit. And we can think of that for the national government too. So let's use 2021 as an example. In 2021, the government raised $4 trillion in tax revenue, but they spent $6.8 trillion. So they had a deficit of $2.8 trillion. That deficit is going to be the amount during that single year where they went over their budget. In other words, they were putting it on the credit card. That's the deficit. It's going to be a 1-year period of time. Now, let's say you already had, $50,000 in debt, and now you're adding $500 in deficit. The debt is going to be that outstanding balance. You might have been, working on that, building up that debt over the span of like 10 or 12 years. That debt is going to follow you. And the same is true in the United States. So the United States has been spending a lot of money over the last couple of decades. And at the time of recording, the current US national debt is over $30 trillion. It's really hard to put that number into perspective. But I believe it's something like, if you had 30 trillion seconds, you'd be going back in time about 960,000 years. Okay, so just kind of visualizing how much money that is. It's a tremendous amount of money. So the debt is this total accumulation of money that the US government owes. It represents that past accumulation of previous deficits, and it's really going to be like the entire amount of money that the government owes. It's enough really to pay $91,000 to every single US citizen. Tremendous amount of money. Now, there are some downsides to debt spending. You might be wondering why you're seeing inflation. Where does inflation come from? When the government uses debt to pay for things, it expands the amount of money that's out there circulating in the system. And a lot of times that's going to lead to inflation, which means that your paycheck doesn't buy you as much and the prices on goods and services go up all around us. So it's actually a problem when the government spends so much money. And the problem typically is for people who are getting paid in cash, saving in cash, or using cash. So we have covered so many topics this week, really a lot of really important concepts here. I want you to kind of know all of these as you go in, to the end of this week and to our assessments this week. Now, I will say thank you for hanging out all the way till the end. I hope you've really enjoyed this section. I want to continue to encourage you to keep doing the great work. As you're looking forward towards your final assignment, just make sure you're making good progress on that. If you ever need to reach out to me, I'm always happy to talk. We can meet or we can communicate over email. Just feel free to reach out. And I hope you have a great rest of the day. Thanks for watching.